4 is the last chapter before your first test, and it's titled Completing the Accounting Cycle. This is kind of like the very end. These are the last things that we do of the month, of the period or the month, the year or the month, whatever period we're looking at. And all these numbers 1 through 6, we've done chapters 1 through 3. We've looked at financial statements already in chapter 1 just to kind of get you acquainted with those. And so 7, 8, and 9 are what we're going to look at in this last chapter 4. All right, so first a couple definitions. Working papers are tools that we use to collect and analyze data. They're not formal documents. They're not going to show up in those annual reports. This is just what the accountants use to crunch their numbers. And the trial balances that we've been doing, those are working papers. Those are not documents that are available to the public or that someone would ask to see. It's really not important to anyone but the accountant. And they use that trial balance to create the financial statements. Okay, so just to recap financial statements of the general layout of them. Remember, they all flow together. We always do the income statement first. Income statement is revenues minus expenses. So just those two types of accounts go on the income statement. The expenses are listed in order, greatest to least, with miscellaneous last. So there's not a whole lot to remember about the income statement. Revenues, expenses, that's it. You don't put any assets, no liabilities, no capital, none of that goes on the income statement. Revenues, expenses only. We get net income, the total at the bottom of the income statement. We got to remember that number. It's going to flow through to the equity statement. So the statement of owner's equity, that's the one we do second. We list beginning capital first, and then we add net income, add investments, subtract drawing. So all those things that affect the equity or the capital, the net worth of the business. Net income, which is the difference between revenues and expenses, add investments, subtract the drawing, and that's your statement of owner's equity. So we get ending capital, that's going to flow through to the balance sheet. The last one we prepare in this class is the balance sheet. It's basically the accounting equation, assets on one side, liabilities and equity on the other. Add up all the assets, get a total, add up liabilities and that number from the equity statement and get a total and compare the two. So we looked at these in chapter 1. Then we kind of took a step back and went to journal entries, T accounts, posting them to the T accounts to the ledger, putting them in a trial balance, adjusting the numbers, updating our trial balance, and then we pull them into the financial statements. So we're kind of coming full circle to in this chapter. Okay, so were those financial statements kind of familiar? Do you remember some of those formulas and stuff? So the last part of the accounting cycle are closing entries. And closing entries are entries that close out revenues, expenses, and the drawing account. And what we're doing is zeroing out those accounts because we reported them in the financial statements. If you look back to the accounting cycle, we reported them here. This is the most important or the most step that most people know because they look at the financial statements. So that's a very important step. It's been reported. Our net income was $10,000. Our assets totaled whatever we come up with, whatever we calculate. So we reported our numbers here. Now we have to close revenues, expenses, and the drawing account. Because we want to start at 0 next month or next year. Okay? If this were the end of the year, December 31st, Our sales account may have $350,000 in it. Well, if we don't close that account out January 1st, say we make a $1,000 sale, we add that to sales, it'd be $351,000. But we don't want that on our 2013 financials. We got to close out those numbers. So we got to close out those accounts and start back at zero. We do not close out assets, liabilities, or equity. Assets stay there. So December 31st, we have $15,000 in the bank. January 1st, we still have $15,000 in the bank. So that balance stays. Just because it's a new year doesn't mean we lose the assets or don't owe the debt. So we keep those on the books. But we close out revenues, expenses, and the drawing because those are only reported for that one period. Does that make sense? Okay. So we close out revenues, expenses, and drawing. Income summary is, the life of income summary is about 10 seconds. Okay? It's just going to be there for a few seconds while you close these accounts. It's just a temporary, it's like a holding account. You just shift revenues and expenses into income summary and then close income summary to capital. I honestly don't know what the purpose of it was. You know, it would be easy just to close them to capital, but for whatever reason we don't. So we have to use this new account. It's an account on its own, income summary. It has a normal credit balance. Means that it's increased with a credit. Okay, so we use this to close the accounts. Income summary is not going to show up on your financial statements. It doesn't have a balance when you do the financial statements. Only after, when you put it in and a few seconds later, take it out of that account. So let's look at this example. The accounts have been adjusted and they've done financial statements. Following balances were taken from the ledger upon landscaping company. They ask us to journalize the 4 entries required to close the accounts. The good thing is, with closing entries, you know exactly which entries you're going to have. You're only going to have 4. It's not like adjusting entries where one month you could have 10, another month you could have 8, another month you could have 15 adjusting entries. Closing entries, you always only have 4. Revenues, expense, drawing, and income summary, where you close the income summary account. So, we've got capital, drawing, fees earned, and then 4 expenses. Let's get another screen up here. Changed all of them. All right, the first entry, let's put them up here. We're going to close revenues. We're going to close expenses. We're going to close drawing. And we're going to close income summary. Okay, so those are our 4 entries. Close revenues, expenses, drawing, and income summary. Our revenue, let's start with the revenue. What's the name of our revenue account? Revenue.
Fees earned.
Fees earned, $779,000. Is that a normal debit or credit balance? It's a revenue account. Debit or credit balance? Where should I put that 779, on left or right? Credit? Okay. This is the revenue. Okay. Follows this pattern. Increases with a credit. So it's got a normal credit balance. So we know we need to put it over here. How do we make that 0? How do we clean out that account? A debit or a credit? A debit, and make it come down. Okay? So we need to debit $779,000 to the fees earned account. So our journal entry, well, let's see. Should I added this before? Got in here. Journal. Our first journal entry, closing entry, will be a debit to fees earned for $779,000. All right, we close revenues to income summary account. So that's going to be our credit. We're going to shift that $779,000 balance from revenues, shift it into the income summary account. So, income summary, we'll have a credit of $779,000. That's going to be our credit. Income summary. So what this does is zeroes out the fees earned account, so at the beginning of next year we can start back at 0. And it puts it in temporarily to the income summary account until we clean that out in just a couple more entries. Okay, so it kind of just hangs out there for a few minutes. You know, if I had created the double entry bookkeeping system back in like 1600, whenever it was created, I would have just put capital here. Wouldn't that have made sense? Wouldn't that have made sense? Put it in the capital. That's where it's going to end up. But they wanted to make it difficult, and I'm sure there's some purpose that I just don't know about. But
They just change it.
so, you know, it'd be so much simple just to put it in capital. That increases capital, and that's where revenues go. They increase capital. But that's, you know, we have to follow the rules. So we have to put income summary and have that account temporarily. All right, so we've done revenues. Revenues now have 0 balance. If we had more than one revenue account, we'd have to do an entry for it too. But if it was interest revenue, rent revenue, have to close them all out. All right, so expenses. We've got wages, rent, supplies, and miscellaneous. Wages, rent, supplies, miscellaneous. Got $389.60. Oh, well, first of all, which debit or credit for these? Are they debit or credit balances? Expenses?
Debit.
Debit. Okay, so $389. We know it goes on the left side. And okay, so put the balances in each of the T accounts for those. If we looked at this is what we would see if we looked at the ledger. We want all of these to be 0. We're clearing out the expense accounts. We're closing them. How do we make all those 0? With a debit or credit? Credit. So we're going to credit each one of them for their balance. Okay, we're closing out. All 4 of these, we've got to credit each one of them individually for each of their respective balances. That credit brings the expense account down to 0, each one of those. Looking back at our rules, we close expenses to the income summary as well. So if we are crediting all of these expenses, what are we going to do in the income summary? Debit. Okay, so, and put in each balance, 389, 60. Okay, put in each balance there. And then we need to put the total in the debit for income summary. Okay, 467,600 is the total of all those. So debits have to equal credits. We call this a compound entry. You could do 4 separate entries: debit income summary, credit wages expense, debit income summary, credit rent expense, debit income summary, credit supplies expense. But if we put it all in one, it's a little bit easier, and we get the same outcome. So 467,600 is debited to income summary. Alright, so done that. Now our balance in income summary is $311,400. It's a credit balance because the bigger side is the credit side. It's a normal credit balance. It's the same as like a revenue. What is that 311,400? What's another name for that? 311,400. What's that balance? Net income, absolutely, yep. Because this was the amount of revenues, this was the amount of expenses, and so this is the same thing as net income, right? Okay, so now our revenue accounts have zero balances, expenses accounts have zero balances, the drawing account. Let's clear it out, and then we'll come back and deal with that net income or that income summary balance. Drawing, $50,000. Is that a debit or credit? Okay, it's not an asset, but it does follow the same pattern, so it's a debit. So we've got 50,000. How do we make that zero? Credit 50,000. Looking back at our rules, drawing is closed to the capital account. So we're going to credit drawing and debit capital. Okay, so debit drawing for not debit drawing. Credit drawing. Credit drawing for 50,000 and debit capital. Okay? Debit capital and credit drawing. There's our credit to drawing, clears it out to zero. What does a debit to capital do? Make it go up or down? Capital? Down. Okay? So that debit to capital is bringing his capital down. Well, that makes sense because he withdrew this money. He withdrew $50,000 this period. So we're taking it away from him. Alright, so we cleared drawing. Closed drawing account. Last thing we need to close is income summary. How would we make income summary down to zero if it's got a credit balance of $311,400? We need a debit $311,400. All right, so let's go ahead and put that in. Income summary. Debit Okay, income summary is debited $311,400. Looking back at our rules, we close income summary to capital. So that's going to be our other entry. Capital, $311,400. What is that doing to capital? That credit. What's it doing? Up or down? Making it go up. Because it falls down here. So we're shifting net income into the capital account. We're adding it to the equity, to the net worth of the business.
So when we take 50,000 out of capital,
We did right here. What we can do, he started out, this is his capital, he started out with $978,500. We debited $50,000, that drawing entry. We just credited $311,400. I think, was that the right number? Now his capital, take $978,500 plus $311,400 minus 50. His new capital balance is $1,239,900. Okay, he started out with $978,500. He took out 50. The business made net income of $311,000. So now his new capital is $1,239,900. This is the number that is reported on the balance sheet. That's the number that's the ending capital on his statement of owner's equity. If you think to the statement of owner's equity, we started out $978,500. Then we would have added net income, subtracted drawing, added any additional investments, which we don't know of any, and we would have gotten this number here. That would have flowed through to the balance sheet. So what we're doing now is updating this account to make sure that it agrees with what we reported on the balance sheet. We closed out revenues, expenses, and drawings, start from zero, the beginning of next period. Shifted everything into capital. So at the beginning of next period, we have no balances in revenues, expenses, or drawing. The only balances we carry forward are assets, liabilities, and equity. So we carry forward our cash, our buildings, our equipment. We still have those things. Even though it's a new year, we still have them. We carry forward our liabilities. We still owe that money.
That is really a long drawn way of just decreasing drawing expenses from earning and added to what capital is left. That's a long drawn way to do that.
Well, yeah, I agree that we could have reduced it by one step by get rid of the income summary account. But that's the way you do it. That's the rules. So you got to let it hang out in the income summary account before you shift it into capital. Yep. There's only 4 of them though. Okay, so you know that you've covered all your bases with closing entries, unlike adjusting entries. Any questions on those 4? No matter what your company, what your account titles are, you're always going to close out all revenues. They could be called sales commissions, rent revenue, interest revenue. You're going to close out all expenses. You could have automobile expense, uniform expenses, subscription expenses, whatever expenses your business has, all of them. You could have 100 of them listed here, depending on what how big your company is. Then you're always going to close out the drawing. If you have more than one owner, you would have 2 drawing accounts, but that's accounting too. So we're always going to be dealing with one owner in this class. And then always close out the income summary, the amount of net income. Okay? Question?